we have Taxation of Crypto Income, a guide by Beyond Returns. The first thing is we have to differentiate the types of income, right? So there's basically two types of income. One is earned and the other one is unearned income. If you want to go ahead and explain a little bit the differences here.
Yes, these are as they sound. This was actually kind of a hard, we were trying to decide what the hierarchy of taxation of income was, and we ended up with IRS definitions. So these are not very sexy words, but they're actually used by the IRS. So on a given personal tax return, unearned income is stuff that you didn't really have to work to earn necessarily. That's not a great way to think of it, but it's unearned. It happens from investments or from a pension or from another source. Earned income is wages that you earn through active work or earning of the income. So that works a lot differently. A quick, easy way to think about it is that unearned income lives on lines 2 through 8 of your tax return of your Form 1040.
If you want to think about salaries and wages, anything you're working for that gives you a W-2 or at 1099 is usually earned income. Tips, disability benefits, business owner income. This is a tricky one. So if you're organized as an LLC, a sole proprietor, all the income that you generate there will be earned income. If you're an S corp, this gets a little bit tricky because usually earned income is, I wouldn't say all of it, but a lot of the compensation part of the income includes Social Security taxation, right? So you have to pay Social Security in the first 140 something thousand dollars and Medicare Unlimited. In the unearned income portion, it could be, it's investment income, pension, Social Security annuities, alimony, and unemployment. But the way it's taxed is a little bit different. It could be capital gains or ordinary income. And so those are very, capital gains. Within the subsection of capital gains, you have short-term and long-term. The long-term portion has preferential rates. Everything else is taxed kind of similarly as ordinary income. It's taxed as, with the increasing amount of money that you make, you go into higher brackets. It's a typical bracket that we talk about.
One note is that 1099 is a shorthand term that we use a lot of times for self-employed people and how they earn money, but they're actually 1099s from all sorts of sources. You get one from your brokerage account. So 1099 can include stuff that is actually investment income. It's not like a hard and fast thing. It's just a term that most people use to say, oh, are you W-2 or 1099? If you say 1099 on the work that you're doing, that's what we're talking about.
All right, so let's move on. So earned income, yes, alimony and employment. Investment income is the big bracket. It's a big bucket here. And so we want to separate that. So investment income, you can have capital gains, passive real estate, interest income. And then within crypto, we're differentiating a little bit. Airdrops, rewards, yield farming, staking.
Yes, so this is not hard and fast. This is not like the IRS has published a version of this slide that we're showing right now. We're showing current interpretation from accounting and tax professionals of their belief that functionally most of this stuff happening in crypto does fall under investment income. That's my belief. If it quacks like a duck, it's probably a duck. That's kind of the framework that we're working off right now, which leads to the kind of a bigger theme that the IRS has not guided on a ton of stuff happening in crypto, but we'll get into that a little bit more.
Yeah, and I want to talk specifically about rewards afterwards because there are instances where, they could be one thing or investment income or compensation income, right? It's like, it really depends. It's like the definition of pornography. It's like that justice who said, I know what it is when I see, or something like that.
I know it when I see it.
I know when I see it, right? So it's really facts and circumstances. And so we want to be really careful of how we're defining this. So let's start here. Trading crypto, and this is a kind of an easy one, right? So it's capital gains. It's either short term or long term. If you're held it more for a year, then it's long term. If it's less than a year, it's short term. Obviously, holding it for over a year, it's better, right? You have preferential rates. You want to talk about wash sale rules here?
Yes, a couple of things here. I'm thinking about how adorable it is that we didn't put anything about losses in here because everyone's just making so much money right now. That's a timestamp. It's October 2021. Everyone's making money, so we didn't even mention losses. It's worth noting that at present, many people are interpreting that there's no wash sale rule in crypto, meaning If you bought a Bitcoin for 60,000 and then it went down to 50,000 the next day and you still wanted to hold, many tax professionals believe, and this is not advice, that you could sell, take a $10,000 loss and immediately buy back in and get your exposure again. This, I think, was under the scrutiny of the new tax bill coming down the pike and may go away as authorities pay more attention to crypto. But as of right now, I think a lot of people hold the belief that you're allowed to do what's called a wash sale, which is not allowed in other investment markets. Like your brokerage account would warn you against doing that.
Let's move on to the next one, lending crypto. So this is by far one of the easiest ones to categorize. It's interest income, and it's taxed as investment income. It's taxed as ordinary income. It's not subject to Social Security and Medicare, right? So if you actually lend money to a friend and you charge, first, if you're lending money to a friend and you're charging interest rates, that is investment income, but it's not what we consider earned income. You didn't work for it unless you're in the business of lending, right? If you're a lending company, or if you are only lending money to different people, that's different. If you're trying to earn passive income and you're lending it out, then it would not be subject to FICA taxes.
One key thing here, and I'm really interested to see if a company like BlockFi, who's being sued by the DOL or somebody, I don't know, to stop doing what they're doing. So BlockFi has products where you could deposit Bitcoin or Ethereum and lend it out, right, functionally on their platform and earn a return on that. The reason I put FMV calculations at the bottom there is because you're supposed to be taxed on constructive receipt, meaning like when you receive what you get. And because crypto is so volatile, like if you have a year's worth of Ethereum income, you need to be calculating the fair market value of what you received on the day you received it, right? So if they're paying
at the time that you received it, right?
Time,
like that's
yeah. So if you received weekly deposits, you're going to have to do calculations with weekly, like very specific prices of Ethereum if that were happening in this case. So that's a pretty tricky place. And that leads to one of our big conclusions at the end, which is keeping great records. Absolutely crucial. Please don't lose the records of everything that's happened here.
Yeah, that's key. And if possible, try to use software to ease the pain. There's a couple of solutions out there that will actually download all your transactions and all of this stuff and integrate very well to the different platforms. And it would be very convenient to use them and give that information to your tax preparer, or to just, if you're doing your own taxes at the year end, it will help you solve some issues. Let's move on to the next one here. It's liquidity mining. And this is a little bit different from the traditional mining. Love if you could define this.
This is a tough one. This is not one that I've ever done, but this is one of the big themes of DeFi, decentralized finance. Functionally, what you can do is lend your capital, whether that's, I think in most cases, it's stable coins or Ethereum, or maybe some governance tokens in DeFi, lend it to a protocol. The protocol then uses some sort of algorithmic market maker to create liquidity on a decentralized exchange. If what I just said sounds like Japanese, it is. The outcome of this is that you probably receive passive income from lending to a protocol. So in my mind, thinking in tax terms, I consider this quite similar to the last slide where we talked about lending. Like, I don't think it's that different if you do liquidity mining on SushiSwap compared to lending your Ethereum and getting a yield on BlockFi. Like, I think the functional big muscle movements are similar, even though what's going on underneath the surface may be different.
Yeah. And we talked about this before, right? With the construction receipt. So if you actually end up receiving, instead of receiving like USDC, like whatever you receive, let's say you receive Bitcoin for as payment for doing this, Bitcoin at the value of the Bitcoin at the moment it enters your account should be the income you received. So that's just note.
Yes, timing is important because you're ascribing a value at the time, and that value is going to find its way to your tax return.
And then if it actually goes up afterwards and then you sell it, that portion is capital gains.
That's right. I think the fair interpretation is that you're taxed on the income that you receive, but then your basis is whatever the cost was that it was received to you, right? So you have a tax basis. You functionally paid whatever you paid in interest income. That's your tax basis. So you now have the ability to harvest gains or losses, kind of manage that tax basis going forward.
And when Robinson's talking about tax basis, it is within the realm of capital gains. So capital gains, your capital gain is calculated by the final sale price minus the tax basis. And the tax basis is what we just talked about, is the price at what you receive it, like if you received it at or bought it at, right? So if you bought it in the market, you paid $30 for some coin, that's your tax basis. If you received it, and at the time of the receipt, that the fair market value of that token or coin is $30, then that's your tax basis. Staking, help here.
Another cousin of lending, honestly. I think of it quite similarly. So staking is, I won't even pretend to know anything about the cryptography, but it has to do with locking up your cryptocurrency to help the network do something broadly. So you can stake in a lot of these different cryptos. What happens is they are offering rewards to stakers. So Ethereum offers a network reward for staking your Ethereum. Solana offers a network reward for staking your Solana. That reward is functionally, in my mind, interest income, but you're not going to receive a consolidated 1099 INT. You're going to have to, like the other lending, like the liquidity mining, you are going to need to be really careful about when you receive it and how much you receive. So in my mind, this is another, it's not even a cousin, it's another sibling of the lending income.
Yeah, this, to be honest, it smells so much like certificates of deposit from a bank.
Really, it smells more like it smells like. Well, yeah, it's very short, but they renew very quickly. So to me, it's like a savings account with like sometimes 3 to 7 day withdrawal thing. Right?
Oh, okay.
Yeah, because they compound quickly.
Yeah, and that's why I think we think that staking is. I think the normal interpretation is, staking is what you receive there seems like interest, right? Mining. This is an interesting one because we actually have a little bit more of IRS guidance, right?
That's right. It seems like mining is treated as a business activity.
Exactly. So if you are a miner, you will probably have, and you don't have a business like an entity set up for it, then it'll probably go on the income generated from this business will go to Schedule C unless it's a hobby, right? But in most likelihood, you're doing this for a profit, and you're doing it. There's a profit motive behind this, so it'll likely go on Schedule C. The unfortunate part of it's reality, right? Your income is likely subject to the self-employment tax, right? The 15.3%.
Yep, that's a tough reality. So this would fall under our interpretation and the way we've laid this out. This would fall under earned income, and I think the kind of philosophical reason for that is that mining sort of does require skill. It definitely requires, it's got like an input and an output, right? You have to input in a proof of work system, you have to input electricity and hardware to set this up. You do have to manage it. So much less so than kind of these other passive income sources where you really have no management responsibility and not much going on if you're staking or lending or whatever. Mining is considered active, right? It's considered earned income.
Yeah. I actually saw the other guy. I was watching a video in my rabbit hole where someone set up a solar panels to mine. I don't know if it was Bitcoin or they were mining different things, but that itself is like complex. You're completely like, it's an entire operation where you actually have to invest in the solar panels, in the converters and the software and everything. It is a form of business, right? So it's set up as a business is not totally bad because you can actually deduct a lot of expenses that you might have.
If you were mining at your house and you could measure the kilowatt hours that you use on your miner versus the rest, that's a useful personal tax deduction on Schedule C.
Let's move on to the next one, which is rewards. And I don't think we have airdrops here, but it's similar in a way, right? The rewards and sometimes you get airdrops. In many cases, I've talked to other people and they receive airdrops for in exchange for working on crypto, being an essential member of getting a project, started and contributed a lot. So there's certain people or organizations that decide to airdrop or reward someone for their hard work. That is very similar to someone getting a bonus at the end of the year, right? So unfortunately, there isn't clear guidance from the IRS, but it smells like compensation income to me.
Again, not tax advice. I don't think you're going to get in trouble for not distinguishing between earned and unearned income on a reward that you're not quite sure. Hey, did I earn this? Or, did I get a huge reward compared to the work that I did and it wasn't really compensation? I don't think that's going to get you in huge trouble at present just because there hasn't been guidance on this. As long as you're being realistic about actually declaring income and hopefully using a tax professional who could guide you on this, I think you're directionally in the right area. But this is another place where we don't quite know because the IRS, by the way, doesn't know. And we're flying a little bit blind here.
I think that there's some key takeaways. One is that, as we said before, we're missing a ton of guidance from the IRS. We need it in order to take positions. In the meantime, there's going to be a huge variance between professionals out there, I think. Maybe not a ton of variance, but like as accountants get more acclimated and educated on the subject matter, there's going to be consensus. There's a lot of complexity, and I think you can speak more about that.
Yes, for every new exchange that you use, for every new type of wallet that has a new staking protocol, the more of these things you add on, you're just adding to the reporting burden that you yourself are ultimately responsible for to consolidate and translate to a tax return. So if it's possible for you to generate, to kind of come up with some loyalty and say, all right, I like the fees and liquidity at this XYZ provider, that's going to simplify things because reporting is just much easier when it's from fewer providers. I know that's hard for people who are way, way deep in the ecosystem because there's so many people who are providing value and being curious and participating financially in all sorts of projects. So that creates a lot of complexity with each additional wallet or project or DeFi protocol or whatever. You're going to be increasing complexity there for yourself on the reporting side.
Yeah, and that's why we urge you to keep great records. Ask tax professionals for help. They should be educated. That's a key thing, and like that's where you have to start filtering the ones you can work with. Are they being educated? Are they understanding this? Are they reading the latest guidance from the IRS? The rulings, the private letter rulings are coming out. These are letters that individual taxpayers are asking the IRS to give an opinion, and they're not really valid for everybody. They're only valid for that specific taxpayer, but it gives you a clear indication of where the IRS's head is at. And so tax pros need to be on top of that. And when in doubt, obviously declare the income. You don't want to be committing felony tax evasion.
That one that is advice. Please don't commit felonies. I will officially put my face on that one. Please don't commit felonies. Not worth it. Yeah. Declare the income. One more thing here, just as a side wrap up. When you trade Ethereum for Bitcoin or Ethereum for Uni or token to token, that is taxable, which is why I came up with the summary that crypto taxation is very onerous. As you get deeper into the ecosystem and you're trading one token for another, those are transactions taxed in dollars, right? Like just because you used a protocol to trade one coin to another doesn't mean that the dollar system doesn't want you to keep track of and declare the gains or losses on those. Like you've got to do that at each point. So please, especially if you're going in with large dollar amounts, please don't get fooled by the idea that you could just switch between tokens and not have significant tax impact. That's I think the main misconception in crypto markets is that somehow if you're in the ecosystem and you're not trading dollars, that it's not taxable, and that is just not the case under current law.
Yeah, you pay your taxes in dollars. So you have to convert everything into dollars.
That's it. I think that's a good start. It's not everything. There are great pros here. Ping us in the comments, send us DMs if you'd like actual professional help. We can refer you to people who are great at this.